Yeah, so while I say we're not traditional value investors and we're usually categorized by, let's say, a Russell or a Morningstar as blend, as Warren Buffett would say, growth and value are tied at the hip. That's part of valuation. So they put us in blend, not traditional value. But when growth is really going, and these are the companies priced on hope and what's going to happen in 2024, 2025, when those are doing really well, they're probably not going to love what we're doing as much. In other words, so we would rhyme a little more with traditional value. And so in those type of frothy markets, that's not our market. But those don't last forever. Prices have gotten pretty high. And like I said, that doesn't mean that the FANG stocks or some of the names that you're familiar with won't do well, or they won't meet the expectations that people think. It's just that as a group, the growth group, where people just pay up for expected growth over the next 5 years, that's probably, as you suggest, have been a little frothy. I would expect that to come back to earth.
What do you think the catalyst for that is going to be? Rising interest rates?
I mean, the real answer is I don't know. I would just say that it always happens. In other words, if the pendulum swings too much one way, there'll be, just like we had a correction in October, that could happen. Things in general are more expensive than usual, but like I said, it could play out in a lot of different ways. Market could fall 18 or 20% tomorrow, or it could just under-earn at 4 to 6% a year for a few years. And that's the way it levels off, meaning lower returns than what people have become.
But surely some things must confuse you if you evaluate the market based on the things that you've observed in history, the degree to which, for example, companies with bad balance sheets haven't been punished.
Yes, so basically there's a reflexive component to that. One thing I didn't mention, that the Russell 2000, which is the small cap universe, that's in the 6th percentile towards expensive, meaning it's been cheaper 94% of the time. And when it's been here in the past year, forward returns have been about flat. So depending on what companies we're talking about, that is super expensive. That should come back over time. It's usually not a good idea to lose money or buy things at 100 times pre-tax free cash flows. Just bad idea.
Joel, I want to ask you a question about factors. You're not a systematic investor, but I've wondered to myself if there's any way you'd ever embrace systematic value investing. And the reason I ask the question is because I know that you teach your students at Columbia to look at a security the way that they would consider buying a house. Well, what if you were buying the neighborhood? Wouldn't you evaluate all the houses in the neighborhood on an aggregate basis and decide whether one neighborhood was cheap relative to another neighborhood being expensive, and maybe the cheap neighborhood on aggregate was worth buying, and maybe selling houses in aggregate in the expensive neighborhood? Because
I hear you.
Because over time, that's worked.
Right. So
the statistics suggest that value is a factor.
Yeah.
Outperforms growth. It outperforms momentum. It outperforms size. It outperforms everything.
Right, but the way people describe value factor as low price book, low price sales, I have no...
Well, there are many ways to slice it.
Right, but the way that they're categorized by, let's say, a Russell or a Morningstar is low price book, low price sales. And to me, that's not a factor that we look at, okay? We're looking at cash flows. So what happens to that...
Would you consider doing it on cash flow?
I do. That's what we do. We value businesses. Sure, we're buying the cheapest. And, you brought up the house analogy. So... if you're buying a house, it's pretty simple questions. They're asking $1 million. Your job is to figure out whether it's a good deal or not. So one question you might ask is, if I rented it out and I could get $70,000 or $80,000 a year net of my expenses and interest rates are 3%, does that sound pretty good? How cheap is it relative to similar houses and all houses in all neighborhoods? So we look at a company, we say, how cheap is it relative to companies in the same industry? How cheap is it relative to all companies I can choose from? How cheap is it relative to how it's been priced over history relative to the market? These are measures of absolute relative value that anyone would use to value any earning asset. We can't value gold or Bitcoin that way, and that's why we pass, okay? We don't value, but earning assets, there are standard ways that everyone would value them, and, if you don't go crazy and you're very disciplined about it, there's plenty of opportunities always.